Good day everyone. We are here to discuss financial ratio analysis, its concept and nature, and show you some illustration and its explanation. I am Arvin Amisola, and together with Rance Joseph Luwalhati, Mary Grace Maloma, Erica Mangundayaw, and Bianca Marinay, we are going to report the following topics. So for the introduction, ratios are nothing more than relationships between numbers. However, it is the most significant management tools available in a financial institution. It provides a meaningful outcomes when compared with other financial institutions or industry averages. So, another techniques in financial statement analysis is ratio analysis. So, ano nga ba ang ratio analysis? So, for its nature and concept, ratio analysis is an analytical tool employing ratio or proportion of a certain item in the financial statement in relation to other related item in the same financial statement or other statements to judge comparative performance. Likewise, ratios are generally meaningful when compared with the key competitors or group of competitors called benchmarking. Similarly, comparison to industry averages is now popular. So, ang ratio analysis ay katulad din ng horizontal and vertical analysis wherein ina-analyze din nito ang financial statements ng company. Sabi nga rito, hindi tulad ng horizontal and vertical, certain item or account title lang ng financial statement ang kailangan. Sa horizontal and vertical kasi, buong financial statement ang kailangan. Tulad din ng naunang mga analysis, we can use ratio analysis sa pag-compare ng financial position ng company sa kanilang mga competitors. So, analysts must be very careful when drawing conclusions from ratio comparisons. It is tempting to assume that if one ratio for a particular firm is above the industry norm, this is a sign that the firm is performing well, at least along the dimension measured by the ratio. However, ratios may be above or below the industry norm for both positive and negative reasons, and it is necessary to determine why a firm's performance differs from its industry peers. Thus, the ratio analysis on its own is probably most useful in highlighting areas for further investigation. So, need maging careful ng mga financial analyst sa pag-interpret at pag-conclude ng ratio analysis. May times kasi na mataas ang nakukuha nila ng ratio kumpara sa nakasanayan or standard ng industry. Kaya may standard or norm para may basihan ang company ng kanilang financial status or position. Kung mataas ang ratio, ibig sabihin, maganda ang performance ng company. Kaya naman need ng analyst aralin mabuti para malaman kung anong gagawin nila kung mataas o mababa ang ratio na nakuha nila. Since the ratio is a statement of the relationship between two numbers and is arrived at by dividing the first number by the second number, the quotient is expressed in any of the four ways. So, as a decimal, as a fraction, as a proportion, or as a percentage. Alam naman natin na ang ratio ay ang bunga ng dalawang number na dinidivide. So, maaari itong express nga in four different ways. Pero, ang kadalasang ginagamit ng mga company ay percentage para madaling maintindihan at mauunawaan. So, for example, assume for instance that the sum of current assets is 50,000 while the current liabilities is 25,000. The following relationship between the two numbers may be computed. So, current ratio is equals to 50,000 divided by 25,000. So, pwede interpret na 2.0 na decimal, 2/1 as fraction, 2:1 as proportion, and 200% as percentage. So, importance of financial mix ratio analysis. So, as a business owner, it is crucial to understand the financial health of your company in order to make informed decisions and guide their organizations toward growth and success. So number 1, informed decision making. Nakakatulong ang ratio analysis para makapag-come up tayo ng good decision since nakikita natin kung anong kailangan gawin at kailangan i-improve gamit ang ratio analysis. Number 2, identifying strengths and weaknesses. Nakakatulong lalo ito para makita ang strengths and weaknesses ng company whenever na i-compare natin ito sa kanilang mga competitors. So number 3, risk management. Sa tulong ng ratio analysis, mimitigate din ng company ang mga risks dahil makikita na nga nila ang weaknesses and threats. Isa din kasi ang ratio analysis sa mga ginagamit sa pag-forecast ng financial condition ng company. So number 4, benchmarking and industry comparisons. Ayun nga, sa tulong ng ratio analysis, malalaman natin ang edge ng company sa other companies na same ng industry. So number 5, securing financing. So, makakatulong daw ang ratio analysis para makakuha ang company ng investments from investors dahil may ipapakita nito ang financial status and condition ng company. So, number 6, financial planning and forecasting. So, tulad ng sinabi ko kanina, ginagamit nga ang ratio analysis sa financial planning and forecasting na ginagamit para mapaganda at mapabuti ang company. So, number 7, enhanced communication and transparency. So, lastly, sa tulong ng ratio analysis, magkakaroon ng transparency sa kalagayan ng company sa mga stakeholders tulad ng owners, employees, and even the customers and investors. So in summary, conducting a financial analysis for your business is essential for informed decision making, identifying strengths and weaknesses, risk management, benchmarking, securing financing, financial planning, improving efficiency and profitability, and enhancing communication and transparency. By regularly assessing your business's financial health, you can make strategic decisions that will ultimately drive growth and success for your organization.
Good day. I am Bianca Senyodosa Marinay and I will be discussing about the liquidity ratio. Liquidity ratio ay required sa isang business para ma-meet yung short-term obligations nila. Liquidity ratios are a measure of the ability of company to pay off its short-term liabilities. Dinedetermine niya kung gaano kabilis ma-convert ng company ang asset for meeting the dues that arise. The higher the ratio, the easier is the ability to clear the debts and avoid defaulting on payments. The following ratios are commonly used to evaluate the liquidity status of the business firm. First is current ratio. Current asset divided by current liabilities. Next, quick or acid test ratio. Cash plus account receivable plus market securities divided by current liabilities. Next is receivable turnover, average collection period, inventory turnover, and average sales period. Current ratio. It measures whether a firm has enough resources to meet its short-term obligation. Quick or acid test ratio. It measures the ability of a company to use its near cash or quick assets to extinguish or retire its current liabilities immediately. Next is receivable turnover. It is used to measure how effective a business is at collecting debt and extending credit. Average collection period. It is used to represent the average number of days between a credit sale date and the date when the purchaser remits payment. Next is inventory turnover. It is the rate that inventory stock is sold or used and replaced. Last is average sales period. It is the average amount of time between payments. This is current ratio. The current ratio is a comparison of a company's current assets to current liabilities that can be used to find its liquidity.
Good day everyone, my name is Franz Joseph Gilwalhati and I am going to discuss to you the solvency ratio. Next slide. Let me give you the definition of solvency ratio. A solvency ratio measures how well a company's cash flow can cover its long-term debt. Solvency ratios are a key metric for assessing the financial health of a company and can be used to determine the likelihood that a company that will default on its debt. So ano nga ba yung ibig sabihin nito? Meaning, abilidad ng isang kumpanya na ma-meet nila yung long-term debt and also yung mga financial obligation ng isang company. Moreover, solvency ratio is one of measure of a company's financial health since it demonstrates a company's ability to manage operation, dito makakatulong na ma-foresee kung ano ba yung kakahinatnan ng isang kumpanya in the near future. There are four main solvency ratio. They are debt to asset ratio, interest coverage ratio, equity ratio, debt to asset equity ratio. And there are four solvency ratio, and I will going to discuss it to you one by one. Next slide. The first one is debt to asset ratio. So ano nga ba yung meaning nito? The debt to asset ratio is a leverage ratio that measures the amount of total assets that are financed by creditor instead of investor. So meaning the debt to asset ratio is a financial metric that measures the proportion of a company's asset financed by debt. It is calculated by dividing the total debt by total assets. So it is important tool for investor and creditor to assess a company's ability to meet its financial obligation and manage risk. So yung formula nito is total liabilities divided by total asset. So for example, Christopher owns a bakery in Midtown Manhattan called Lucky Charms. He's recently been worried about the finances of the organization as he prepared to apply for a loan extension. So he decided to conduct a debt to asset ratio test to determine the percentage of his expenses account for by financing. So with both number inserted into the debt to asset ratio equation, for example, 43,000 divided by 31,200, so equals is 1.37. The next one is interest coverage ratio. So ano nga ba yung meaning nito? The interest coverage ratio is a debt and profitability ratio used to determine how easily a company can pay interest on its outstanding debt. So meaning, the interest coverage ratio is a financial metric that assesses a company's ability to meet its interest payments on outstanding debt. So, this ratio indicates how many times a company can cover its interest obligation with its operating income. So, yung formula nito is earnings before interest and taxes divided by interest expense. So, example is, if a company's earnings before taxes and interest amount to $50,000 and its total interest payment requires equal $25,000, then the company's interest coverage ratio is $50,000 divide $25,000. So, equals 2. So, meaning, an interest coverage ratio of 2 or higher is generally considered satisfactory. Next slide. Third one is equity ratio. So, ano nga ba yan? The equity ratio is a financial metric that measures the amount of leverage used by a company. So, meaning, this ratio provides insight into the extent to which a company relies on equity to fund its operation and investment. And also, a higher equity ratio indicates a large proportion of assets in financed by equity, suggesting a lower financial risk and greater stability. But on the other hand, a lower equity ratio may suggest a higher reliance on debt, which can increase financial risk. So, ano yung formula nito? So, shareholder equity divided by total assets. So, example, say that you're considering investing in ABC Widgets Incorporation and want to understand its financial strength and overall debt situation. You start by calculating its shareholder equity ratio. So, from the company's balance sheet, you see that it has total of $3 million US dollar, total liabilities of $750 US dollar, and total shareholders of $2.25 million US dollars. So, you need to calculate the ratio as follows. So, $2,250,000 US dollars divide by $3 million US dollars. So, you get 75 or 75%. Meaning, the higher the ratio, the stronger the indication that money is managed effectively and that the business will able to pay off its debt in timely way. So, a high ratio value also shows that a company is all around stronger financially and enjoys a greater long-term position solvency. So, next slide. So, the last one is debt to equity ratio. The debt to equity ratio is used to evaluate a company's financial leverage and it's calculated by dividing a company's total liabilities by its shareholder equity. This ratio provides insight into the financial leverage of a company. A higher debt to equity ratio indicates a greater reliance on debt to finance operation and investment, potentially increasing financial risk. So, the formula is total liabilities divide total shareholders equity. So, example, if as per the balance sheet, the total debt of a business is 50 million US dollar and the total equity is worth 120 million US dollar. So, meaning 50 million US dollar divided by 120 million US dollar equal to 0.42 cents. So, this means that for every dollar in equity, the firm has 42 cents in leverage. And a ratio of 1 would imply the creditors and investor on equal floating in the company's assets. So, a higher debt equity ratio indicates a levered firm which is quite preferable for a company that is stable with significant cash flow generation, but not preferable when a company is declined. So conversely, a lower ratio indicates a firm less levered and closer to being full equity finance. So meaning the appropriate debt to equity ratio varies by industry. The end of my topic. Thank you. Next reporter.
Good day everyone. I am Mary Grace Maloma and I will be discussing profitability ratios. Profitability ratios. Profitability ratios are a class of financial metrics that are used to assess a business ability to generate earnings relative to its revenue, operating costs, balance sheet assets, or shareholders' equity over time using data from a specific point in time. It is a fundamental tool used by financial analysts and investors to assess a company's ability to generate profit. They provide valuable insights into the efficiency and effectiveness of a business in converting revenue into earnings. There are several types of profitability ratios, each offering a specific perspective. The first one is the margin ratios. These measure profit as a percentage of revenue such as gross profit margin, operating profit margin, and net profit margin. A higher margin usually indicates better cost control and pricing strategies. Next is return ratios. These measure profit generated per unit of another factor like return on assets, return on equity, and return on invested capital. They assess how effectively the company utilizes its resources to generate profit. And last is earnings per share. This metric measures profit per outstanding share, indicating potential returns for shareholders. It is a monetary value of earnings per outstanding share of common stock for a company. It is also a key measure of corporate profitability and is common use to price stocks. Profitability ratios can shed light on how well a company's management is operating a business. Investors can use them, along with the other research, to determine whether or not a company might be a good investment. By understanding and effectively utilizing profitability ratios, you can gain valuable insights into a company's financial health and make informed investment decisions. Remember, these ratios are just one piece of the puzzle. Consider them alongside other financial metrics and qualitative factors for a well-rounded analysis.
Good day everyone, I'm Erica Mamundayaw and I will be discussing about the growth ratios. So, growth ratios. Growth ratios is the growth of a company indicates how its business is growing from one period to another. Also, growth rates can be positive or negative depending on whether the size of the variable is increasing or decreasing over time. Growth rates were used by biologists studying population sizes, but they have since been brought into use in studying economic activity, corporate management, or investment returns. Other than that, a positive growth rate indicates a variable is increasing over time. A negative growth rate indicates that is decreasing. Growth rates can be beneficial in assessing a company's performance and predicting future performance. The following growth ratios are commonly used. First, earning per ratio. Second, price earning ratio. Third, dividend yield ratio. Fourth, dividend payout ratio. And fifth, book value per share. So, earning per share. Earning per share is a company's net profit divided by the number of common shares it has outstanding. And EPS, or earning per share, indicates how much money a company makes for each share of its stock and is a widely used metric for estimating corporate value. Other than that, a higher EPS indicates greater value because investors will pay more for a company's shares if they think the company has higher profits relative to its share price. Second, for the price earning ratio. It is the proportion of a company's share price to its earning per share. A high price earning ratio could mean that a company's stock is overvalued or that investors expect high growth rates. Companies with no earnings or are losing money don't have a price earning ratio because there is nothing to put in the denominator. Third is dividend yield ratio. Dividend yield is a security's annual dividend payment expressed as a percentage of its current price. This percentage yield tells you what your annual return on investment will be at the price you paid for the security. A high dividend yield can be appealing since you are getting more income per dollar invested. But a high yield is not always a positive thing. It could mean that the company's stock price has been falling or dividend payments have been increasing at a higher rate than the company's earnings. Second to the last is the dividend payout ratio. The dividend payout ratio is the proportion of earnings paid out as dividends to shareholders, typically expressed as a percentage. Some companies pay out all their earnings to shareholders, while some only pay out a portion of their earnings. If a company pays out some of its earnings as dividends, the remaining proportion, or rather portion, is retained by the business. To measure the level of earnings retained, the retention ratio is calculated. Lastly is the book value per share. It calculates the common stock per share book value of a firm. And if a company's book value per share is higher than its market value per share, then its stock may be considered to be undervalued.
So that's all. Thank you for listening.